Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. My guest today is Eugene Ng. He's based in Singapore and is the founder and CIO of Vision Capital, which is a fundamentally driven, bottom-up and long-only equity fund with a focus on investing in companies that reflect the best vision for our future. Eugene is also the author of Vision Investing and has represented Singapore nationally in water polo, having won a gold medal at the 2007 Southeast Asian Games. In our conversation, we cover his investing framework, red flags as an investor, and lessons applicable to investing from elite sport. I hope you enjoy my conversation with Eugene Ng. Welcome. Thanks for being here, Eugene. But I think just to give listeners a sort of background sketch of yourself and your life, could you just sort of give them a rundown of what got you up to your career and life to today?
For me, I'm actually from Singapore, born and bred in Singapore, born to, I would say, an average family, of which my mom and both kind of middle income parents. My parents were actually divorced when I was about in my teens. This was what happened was my dad was actually a habitual gambler. He actually started gambling a lot and got our family into a large debt. And what happens was that because of that, my parents were divorced and my dad left us and my mom had to bring us up single-handedly. Now, so with that, what happens, I went into university and that's where I kind of started my path. I started doing economics and finance. That's because always I like to think about how the way agents kind of think about it and react. And that always gave me a very interesting perspective about things because it's not something that is fluid and that gives a lot of insights. I started my career back in 2008. That was right at the smack of the financial crisis. And that was really, really insane. I think when I started that, I think it was very difficult to find a job. And thankfully, I managed to start my career with Citi as a management associate, being the last one into the batch. And that was a changer. I was there for them for 3 years. Did credit cards marketing, insurance marketing. As you can say, if you can sell insurance, you can sell anything. And that's where I did FX advisory after the FX sales. So I covered corporates. So any corporates that need foreign exchange, I help them. So the way to kind of explain to my grandmother how I would do it is that think of me as being a money changer, exchanging money from one currency to another, but not really seeing the notes itself. It's just really seeing numbers. And then what happens is that after that, I moved to JP Morgan when I was there for 8 years, also covering the same thing, doing FX sales. And that's where I left JP Morgan sometime back in beginning of last year, around February.
Yeah.
So with that, I actually moved to a new job. And I think that's also where I, in the midst of it all, really started writing my book, which was Vision Investing right during that smack of the period. And I think that was extremely crucial. But of course, in between, I had an accident, which I can share a little bit more of how that. But I think that accident itself was really fundamental to how I started investing.
Yeah. So I'd love to drill down if I can.
Yeah.
Sort of, your accident, sort of what you taught you and just talk me through it.
Yeah. So what happens was on a very fateful Christmas about 7 years ago, I had a drink too much at a beach club, And what happens is that I decided to do the most crazy of things was to do a somersault into a very shallow swimming pool. And so what happens is that the top of my head actually hit the bottom of the swimming pool. And I heard a very loud thump sound. And before I knew it, I kind of knew my neck was broken. Thankfully, I could still move all of my limbs. But that was when the doctors after that kind of diagnosed it to that I got a Jefferson C1 fracture. So if you think about it, in our neck, the very first bone, which is a round bone, basically it's kind of got split into two. The back joint right now recovered, but the front is still open. So actually right now, I still have an open fracture.
Shit.
My neck is still broken. So if you think about it, which is insane. And how serious was it is that my doctors was to say, I'm kind of like a living miracle. 99% of the people who get it actually die. And 99% of the people who have it is paralyzed in some form of it or another. So for me to be still walking here and still being able to do what I can do, it's truly a living miracle on every single day. And I think that's where after that injury, right, my wife actually told me, why not do something with your life? And I think that was really a crucial moment, right? What else could I be doing? Because my perspective of life started changing. It became very different about things and I wanted to treasure it more. But what else could I do? And that's when I started to say, okay, I'm good at math. I like investing. I'm good at numbers. I always had an affinity for investing, for equities, and I needed to build financial wealth, right? So that's where I started pivoting into investing. And now the quest really came about in three things. I went globally and I started finding, okay, how do all the richest make their wealth? And it boiled down to three things. One, start your own business. As you can see, founders, business owners, all the wealthiest all been business owners. Second, investors, investing. You can invest your way to great success. And the third one was really property. Property was another asset class in which, wealth generated from properties could immensely change fortunes. Now, I was at a stage of my career where I didn't have too much money to make that much of properties. And also the regulations in Singapore, as you can see around the world, have also been increasing, making it very difficult to make money from properties as perhaps maybe 10, 15 or 20 years ago. So properties was kind of okay, it's there, but it's out, right? Starting a business now, I think back then I was working for a company and starting a business was relatively much more challenging. So that to those who kind of really bought into investing. So I started the path of finding investing and to see how can I really get my success right. So to me, everything is about getting the success right and making sure whatever I'm doing is consciously in the right direction. So always when I'm thinking about investing is, okay, what do I do then next to make sure I can be one of the best investors in the world? And that's really how it is.
I'd love to sort of your early influence, because I'm pretty similar myself. I didn't start investing till 18. I was literally learned from then. What were your sort of early influences, especially with growing up and then sort of realizing investing is the way? Did you have any sort of predetermined, like a bias towards value, do you reckon? Or you were very risk averse, so this sort of naturally fits in your investing style? Or how did you sort of find your own style?
Yeah. I think my first stock that I bought was when I was actually in Citi. was Citi stock. So when I was in 2008, when the financial crisis happened, the Citi stock price kept coming down all the way, right? It went from up to to $5, and I bought the stock thinking, the company will be fine. And of course, before long, it went to $1. And even on a reverse split adjusted basis, it never recovered back to it. So I think that was a very pivotal moment because I bought it without looking at actual financials, understanding the durability of the moat, the business itself, thinking that, it's cheap. It could definitely go up from there. And obviously it couldn't. I think that was an extremely pivotal moment. I think, so in my chase in investing, what happens is that I'm always a learner in the sense that I'm willing to pay to learn. And that's extremely crucial to me. So I actually did a value investing course in Singapore. It was with a company called AI. Okay, I heard, value investing has been doing well. I wanted to find out how to do it, right? So basically, I did a 3-day course trying to find out. And what happens is that at the end of the course, they gave a framework of how to look at companies. And, obviously, if revenues go up, profits go up, the stock price generally goes up. Now, what happens is that I think when it comes to value investing, it became a path of where you are thinking about investing in companies who are really great companies, doing very well, generating revenues. What happens is that typical example was like this. There was this company called Viacom, which is in Singapore. So in Singapore, you have to have what we call a certificate of entitlement, COE, in order to drive a car. And what happens is that mandatory checks are there every year for you to have a regular annual health checkup of your car. And that's mandatory. So there are only 2 companies broadly in Singapore that does it. So you kind of think about it as a duopoly, right?
Yeah.
The company is great. Net income margins are like 30, 40%, which is like great. I mean, you don't have that many companies in the world that have net income margins of 30% and above. And you realize, okay, if the car population is not going to grow, the revenues aren't going to grow. If the revenues aren't going to grow, the profits can't really grow because there is a limitation to how much they can grow. Now, if the profits can't grow, the stock price can't grow. The math kind of stacks out, right? So I was like, okay, it's a dividend paying stock, it's paying me 5%. I'm going to make 5% of returns. But there has to be something better than that, right? So when I started changing my thought process about that, I literally swang. So I did my whole search and whole investing in Asia and tried to find, is there a company that could be growing 25%? Their profit margins are just growing faster and maybe their profits are growing 40% a year, right? And even if I'm paying more higher valuations, perhaps the stock price could actually go up far more, right?
Yeah.
And that's where I could actually get market beating returns. So that shift of mindset totally actually shift me in that old way from value to growth right away. It was just by nature. I didn't read any book. It was just looking at a company, spending a lot of time and just really figuring around the dynamics. And so that actually expanded my search from Asia to the US. And when I did that search, I was like, oh, wow. I could really find a lot of companies that have that kind of qualities, right? And that really blew my mind. And that's really sparked the whole journey. And it started to, in a quest, okay, now this has sparked a whole new journey of, now US is obviously very different. What else can I do to then come up with a process? Because yes, you read many books, and the top investors, they all have a process. What is my process? What is my philosophy that kind of leads into it?
Yeah, because I think I'm sort of in a similar spot. Australia's market, I think, only makes up 1% of the global when you count for US and European. So do you ever find that it's hard? Because I sort of believe certainly in like a bit of home ground advantage. I sort of know Australian business a little bit better. Do you ever feel like you should maybe invest more? Because as I understand, you invest very globally. Do you ever feel a tendency towards Singaporean, or are you very much globally now and in that sort of realm?
I think about it when it comes in investing, it's really about the market cap versus the opportunity, right? If it's a Singapore company, but it's truly global, has a very large market opportunity and it's expanding tremendously, it's a company that I would definitely look at. And in Singapore, for example, there are two companies that I invest in, which is C Limited and in Grab. And both of them have fairly addressable global markets, and for Grab, a more regional aspect for Southeast Asia. And that still works out for me. But if it's a very local company that has a very local, very niche place in a very small geographical region, which kind of limits your total addressable market. If you can't grow into that total addressable market, it will eventually cap and limit your growth. And you can't limit your growth if effectively the company can't grow any much bigger. And if the company can't grow any much bigger, which means effectively the stock price can go. If the stock price can go, we're really looking for long-term compounders and multi-baggers here. We're not looking for something that can grow into its limits and then eventually not grow. So I always think about it from that perspective, and any business that I'm investing from that aspect.
Yeah. Just to invert a little bit, is there any common characteristics or certain criteria, specific situations that you really try and avoid as an investor? Are there any big red flags that you're always on the lookout for now? And have you talked me through any experiences where you learned sort of what not to do?
So I think the way to think about it is, let's try to find what are we looking out for, and then what you're not looking out for, then naturally those that you're not looking out for tends to be excluded, right? So in the world of investing, Abesender actually did a study from between 1926 to about 2016. He studied the entire investing universe. And of that investing universe, about roughly 1% of the companies, of that 25,000 companies, about 1,000 companies accounted for majority of the stock market returns. Now, what I'm trying to say is that here, right, in the entire investing universe, only a very small percentage of companies account for the majority of the returns. Most of the companies actually gave returns 0 to even negative. Now, of that 1%, half of that, or even very much smaller percentage, about 100 companies accounted for about 50% of all of that returns. Now, so when you really think about the investing game, the investing universe, right, there's a big universe, and you're really trying to shift into that very small pond where some of these top greatest companies are really there. So I wanted to shift my process into there, right? And when you went back to it, so the things that I really am always be looking out for is, in the very long run, what I want to achieve. I know what are the main drivers of rising stock prices. Rising revenues that eventually lead to rising profits. Rising profits lead to also rising cash flows, and that results in a rising stock price. I always say this, find me a 10-year chart of a company in which you have rising revenues, rising profits, and rising cash flows, and not have a rising stock price. It is almost not there, right? So I'm looking out for something like that. Now, when it goes back to that, okay, I have fast, rapid revenue growth. It's about the durability and the sustainability of it. Now, so when I go into revenues, I'm looking at really the business. What business is it? What is it doing? Is it something that is sustainable? Is it something that is recurring? Is it something that people can keep doing? So I'm looking at it from a durability of the revenue. And that goes into competitive advantages. Is the competitive advantage strong enough for it, right? I like network effects. I like economies of scale. I like operating leverage. I think those are really technological advantages that companies have that drive that growth of revenues, because revenues can then suddenly start growing exponentially, right? And now when it comes back into then profit margins, I like rising profit margins. It need not necessarily be profitable. It can also be not profitable. But most importantly, there has to be a path to profitability. And when you think about it, it comes into the unit economics of the business. Are you right now making money on every customer? It's just that maybe right now you're actually reinvesting that profits, so you're not seeing it as a loss. And that's perfectly fine. If you can do that, that's not an issue. So I'm really looking at the durability of the business, rising profit margins, and I love it especially when profit margins rise. You know why? Because that means profits are growing faster than revenues. If profits are growing faster than revenues, there's a very high likelihood that the stock price will rise even faster. Even you can have, very high valuation multiples, those can get compressed quite a fair bit. And we have always seen long after long, that has always been the massive drivers. Always go back down to it, right? I'm always looking back at that. Now, when I think about it, just to invert a little bit, when I think about revenues, it's really think about it from a total addressable market, right? You want something that's a first mover, a disruptor, right? And it's something that's really changing the market. Now, do I like a market that is perfectly competitive, right? Has 1,000 people and I can't differentiate you from another one. You might be great, but you can be very, very niche. Now, the way to think about it is in investing, everything is a game. I like it when I see monopolies. I like it when I see duopolies or even oligopolies. Because what it means is that they have pricing power, they have large share of the market, and they have market dominance. So a lot of the companies that I invest in tend to be almost monopolies or duopolies or even oligopolies in their very own niche. It's because you want pricing power. You don't want a company to be in a perfectly competitive space and they'll be fighting every day non-stop to get your customer, to sustain your profits, and to keep growing. So if you think about it, to me, investing is always a game about really getting all the odds in your success, right? We want to play an unfair game. We want to bring the odds of it into success and finding that. So that's always a very, very big theme of how I think about it. Now, when I go back into the margins, ultimately, businesses are all run by people. I love founder-led businesses. I love founder-led who are founder-owned as well, have high insider ownerships. But sometimes a lot of these companies, when they become very big, the founders might step down and eventually they get run by professional managers. And that's perfectly fine too. So I have a subset, right? And when I looked at it, founder-led companies actually tend to outperform non-founder-led companies because they have skin in the game. They have insider, right? They tend to invest more in R&D. They tend to do a lot more things that are more long-term for the business rather than more short-term focus. So you see, I'm finding founder-led because I know founder-led companies tend to outperform. I find top managers, for example, managers, I look at Glassdoor ratings. Tell me, for example, are the managers doing a good job? Are the people, the employees loving the CEOs, how they're running the company? That gives me, right? So the way I'm thinking about it is I want good managers, and that good managers can always be very long-term focused and running that up, the businesses. So I always think about it really from that aspect. Now, if I think, ask me the reverse, right? What do I not look for? Red flags. Perfectly competitive businesses. I don't like that. Companies that revenues are just not increasing. They're declining. The margins are deteriorating. Profits are just deteriorating even faster than revenues. Somehow the company, when it grows, the margins just don't grow. And that becomes a red flag, right? I mean, how long can you keep sustainably burning cash to do it? Eventually, the game has to stop. People won't be able to finance. They won't see the story. It can go. And that story can go for a while, depending on the market opportunity. But that doesn't last very long. And that's extremely, extremely important, the way to think about it. Management. If a manager is inconsistent, always thinking very short term, pay themselves much more than they do others, accounting irregularities, inconsistency in how they communicate. They could be saying one thing, but they're actually doing something. That tends to be very red flags of how I'm thinking about it. So the way to answer your question, everything that's totally none of what I said at the beginning are probably red flags, and that always. And I always find it that way, right? You look at the investment thesis of a company, the lesser the red flags it is, the easier for it is as any investor to see the story of it. If I have too many red flags versus something, it's about the story, right? And if I can't understand the story, the next person is probably not going to understand. If they're not going to understand, they're not going to buy, right? I kind of realize the best investments that I always had, the stories it's just naturally things. I don't have to explain so much or to justify so much why I have to invest in this company. Yeah, it just comes so natural. And that's when I realized that. So yeah.
That's a good way to go about it. If you can't explain an investment in 15 seconds, then it's probably not worth investing in. But yeah, you spoke about durability of revenues. So you're a long-term based investor, investing for the long term. How do you sort of view volatility and short-term news? How do you sort of write it out or act on it if you do?
Correct. I think in investing, when we go back to it very long term, it's why we do investing is if you graph a chart of a stock market, for example, we look at the US S&P, right? The US stock market is always from the bottom left to the top right. That is over easily 100-year horizon, right? That's really truly the long term. But what happens is that on any given year, the stock market can go up or go down. If I were to give you this statistic, right? On any given day, you actually have a 51% chance of making money because the stock market naturally goes up. Almost like a coin toss. Now, if I go that up to 1 year, that number increases slightly, maybe to around 55%-ish or so. Now, when I go that up to 20 years, that number goes up to 80%. So if I have a holding period of 10 years, on any day or throughout the entire backtesting period, I have an 80% chance of making money, 20% chance of not losing money, right? Now, if I increase that to 25 years, I have a 100% chance of not losing money. I have dramatically actually increased the odds of my success. I am playing a game right now where it's not 50-50 that I will win or lose. There's actually 100% that I will win. So by just investing long term, thinking very long term, being a very long term focused investor, I've literally swung my odds of success to 100% and not having to lose. So my downside actually becomes zero right now, the way I think about it probabilistically, right? Now, when I go back to volatility, which is your question, right? On average, the markets fall, and on any given year, anywhere between, I would say, 10 to 20%, right? But what happens is that the way to think about it is how frequent those falls. I would say on every 6 months, the market falls between 5 to 10%. Now, I would say in every 3 to 5 years, the market falls between 10 to 15%. And if you think about it from any between 10 to 20 years, the market falls anywhere between 20 to 30, even 40%. If you think about it, that drawdowns and volatilities are happen. You need sell-offs in order to go up to a market. A market cannot be always rising. It kind of goes in ebbs and flows, and that's how we just need to go with it. To me, I'm always very focused about two things. In volatility, I think about it in two things. One, you have price volatility. The next thing you have is business volatility. Price volatility is really just the stock price volatility. You're reacting to a stock price in the market where there is a willing buyer and a willing seller for a company and the stock. But over the long term, we're really looking at business volatility, right? Like the question I have, if Amazon is growing revenues at 40% top line, right? And Amazon stock price, for example, drops 15%. Has anything really fundamentally changed to the business? No. Then again, the question you should also be posed opposite in the direction. If Amazon stock price rise by 20%, should it also be the case, right? I mean, that is what I'm trying to bring across. Volatility can be two ways. But more importantly, we should always I'd rather not look at it from a stock price volatility, because I know Mr. Market is really a voting machine in the very short run. There's a lot of noise. And it is what it is, because we are all made of human individual agents that are all trying to make a price on the market. But when you go really long term, you're really focused on the business volatility. So if you look at a long-term chart, which I have in my book as well, the stock market goes up because earnings goes up over the very long run, period. And obviously earnings is being driven by revenues. So if you find a business that is going up long term, as I mentioned just now previously, it's almost very difficult to find a company whose stock price doesn't go up. And so I'm really just fishing it and really thinking and really focused about it. Now, when it comes to business volatility, there can be intra periods or quarter to quarter. So it's important to understand the seasonality of the business, correct? If a company is growing very fast at the beginning stage, seasonality might not occur. But if a company is starting to mature, seasonality can occur. Like I give you an example, right? In retail sales, you look at most e-com businesses, typically year end, where you have Christmas, is where Q4 typically tends to be the highest seasonal sales, right? And Q1 tends to have a lull. And that kind of seasonal aspects you must understand. Doesn't necessarily mean that you have a blow up Q4 revenue growth, means it is dramatically good. It has to be looked at in perspective of where the longer term context is on the time frame and also on a shorter term period time frame. So I really always think about it. I always say, be a business focused investor rather than be a price focused investor. And I think that's always very important. And that's how I think about volatility.
Yeah. Probably much less stressful that way if you just focus on the business rather than, but yeah, because you mentioned Mr. Market and stuff. So how do you see your competitive advantage? Because obviously it's a big investment world. We're competing against a lot of other people. What do you think your biggest competitive advantages are? Is it a long-term, psychological, analytical? How do you view it?
I think the biggest competitive advantage we have as individual investors is really temperament. The way we have it is that because our capital is so long-term, we don't have, as institutional investors, when the markets are high, people are rushing to give you capital, asking you to buy stocks. And the markets are down, they're busy taking money off. That math, for example, works massively against them. And that's why if you pull out most stats, even by Spiva, the scorecards, anywhere from, I would say, 70 to 90% of institutional fund managers underperform the market and the benchmarks, right? That is because mathematically, they don't have permanent capital. And because capital is short-term, that naturally just causes them to buy high and sell low. which mathematically just causes them to underperform. Of course, you have fees and everything else, right? I think what we really have as individual investors is that we have permanent capital, and you need to make your capital permanent and the way of how you react to it. Stock markets will go up and down, right? Always be very focused and the stock market is a weighing machine, not a voting machine. You're holding businesses. If the businesses are doing fine, I have no problems. Like if any of some of my top convictions, for example, the 40%, I will be rushing in to buy a lot of it. And that's really how I'm thinking about it. The stock price is just a price for me to own the business. And if I think about it, I love sell-offs because sell-offs are opportunities, and not be fearful of them and to really be thinking about it. I think that's temperament is really important. We got to be really holding it for the very long run, because everyone just keeps buying and selling. And just having that temperament is really so important, and having that long-term perspective.
No, it's totally true. Because a lot of my friends have gotten investing over the past year, and same thing. All I tell them is like, they sort of come from a gambling background. I was like, man, you just got to chill long term. It's not horse racing. We're not, yeah. But I've heard you speak about before how your portfolio construction is sort of 20% of the business's return, 80% of all the returns. Could you just dive a bit deeper in sort of how you go about constructing your portfolio and your views on it?
Yeah. So the way we do it in Vision Capital, which is the portfolio that I run, right? It really stems back with my life mission. So my life mission is to excite, to inspire, and to empower people to pursue their dreams and to grow their businesses to create long-term, sustainable, positive value by making the world and mankind a better future. When I set up Vision Capital in the first place, and my investing philosophy and the mission was really stemming from what I learned from David Gardner. It was very, very influential in how I did it. Was to really invest in companies that reflect our best vision for our future, changing and shaping the world for the better. Now, when it goes back to that, it really is about shaping. So when the companies that are investing, they really have to follow what I've shared in terms of what I'm looking out for. But ultimately, they have to be changing and shaping the world for the better. And that's why the approach that we have is what we call vision investing. It's very different. It's not just growth for the sake of growth, but growth in all aspects of growth in any company. But it's really, you have to be really very intentional about the companies that you invest. To give you an example, right? I don't like gambling stocks because of obviously what has happened. And if any company has any sort of sense about relation to gambling, I just don't touch it. It is what it is, right? I don't look at oil companies because I think the oil companies are actually polluting the environment. We do need it. We do need it to get about our daily lives. But would I want to own something that is massively, destroying the environment? No. There's some of the large consumer goods companies that are just massively generating a lot of plastics. When you go to the beaches, you see a lot of plastics, and it's just crazily destroying our environment. That's something that I don't want to. So it's very, very intentional in terms of the type of companies that I'm doing. If a company is doing something that I think is just not creating enough value, they could be profitable. It's fine for me to say, give it a pass, right? So I give an example, right? Something, I think in investing, sometimes you always have to have two opposing thoughts. And this is one opposing thought that I've recently just been thinking about. For example, which is buy now, pay later. Now, if someone has to borrow $20 to buy something has to be wrong, right? Because financially, the kind of advice that I'll give to anyone is don't borrow to buy something. And there are only very few asset classes in the world that you actually really can borrow and invest safely. One of which, to be honest, very rarely is just only property.
Yeah.
Right? Other than that, I don't even give that kind of advice, right? So having a 100% buy now, pay later company clashes a lot with my philosophy. Now, do I think buy now, pay later can work? Yes. I think it's great. It can be amazing. But it clashes tremendously with my philosophy. And hence, I do say no. Right? Because it's really very, very intentional. Now, do I have some companies that also offer some buy now, pay later? Yes. But it's a very small percentage. It's more really to help some of the guys, but it's not a massive main driver, right? So I think it's really very intentional. Now, when I think about it, going back to the question about the 80-20, right? I think the 80-20 Pareto rule really exists in all nature. So the way to think about it is, I don't do a concentrated portfolio. I do a very diversified portfolio because I want to sleep at night, right? So the way I always say is, when I started off, was intentionally to say, I want to get my portfolio to at least a minimum of 25 stocks, of which I wanted to get up to there. And right now, actually, I'm more than 80 companies that I own, which is extremely, if you can, some say very, very, very diversified, right?
Yeah.
But the way to think about it is, Now, if I pose a different scenario, right? In 2020, for example, I had almost more than 80 companies, and more than 80% of them actually outperformed the market.
Sure.
Which is 60 over companies, right?
Yeah.
So if one can ask, right, I own 80, I'm actually looking like almost like an index, but I'm not actually an index because you can actually beat the market over the long run. And it's about really intentionally finding the winners. So to me, if I'm finding the winners, I can still be very diversified, but diversified and owning the businesses that I want and intentionally in the right framework. Now, what happens is that I think if I look at it, my numbers, about 20 to 30% of my winners have actually accounted for 80% of the returns. Now, this is a very interesting mathematical aspect, which is something that is very important as we are investing in stocks. And I want to run through this. When you buy a stock, the maximum a stock price can go down is 100%. You lose 100%. Now, when you find great companies and you're investing for the very long run, you get multi-baggers, which means the downside is limited in the sense minus 100%, right? But the upside is unlimited. When you're looking for multi-baggers, you have 3, 5, 10, 50, 100 baggers. You have 100:1. If you get 100 baggers, the risk reward is really 100:1, right? And if you're finding and owning multi-baggers, you start realizing that your portfolio returns actually will start beating the market. And so really, you are skewed in that construct, right? So in my portfolio, it's filled with multi-baggers. It's multi-baggers all around, literally.
Yeah.
Because that is how it has been constructed. And I've just held it because I know the minimum it can go down is 100%. Now that boils down to the question, right? Which is what I think that I don't do to kind of sabotage myself. I don't do short selling because when you're doing short selling, the downside is unlimited right now, right? Which totally works against my favor, right? I don't want to do anything now. And then next, do I sell naked options? Do I sell calls? Do I sell puts? No, because again, the downside is unlimited. I'm only earning the premium and my downside is unlimited. I don't like that. Do I take leverage? No, I don't take leverage or I don't take margin because yes, I might have amplified returns, but if it goes wrong, I'm going to be wiped out.
Yeah.
If you think about it, the very simple math of the greatest investors in the world, they've been the greatest investors in the world is because they've been investing long term. They have track records of 15, 20, 25 years, 30 years, right? The whole thing about investing is not just being the winner in a 1 year game race. It's about really being the winner in a very long race. So all I'm trying to do is remove all of these things and to just reduce odds of failure and to swing my odds of success in my favor. And so it's very, very intentionally done it that way. And when you look about it from a mindset, from a construct standpoint, literally, it's almost mathematically geared towards a higher probability of success and a probability of failure.
That's why you can't play the game if you're knocked out. So you may as well just, stick at it for the long run. To sort of go back a bit. So you've played some high-level sport. You've represented Singapore at the Southeast Asian Games, won a gold medal, if I'm right. Is there any lessons you still pull from your sporting days? Do you think anything that you learnt during playing water polo can be applied to investing, or how do you view your previous sporting life?
So I played water polo since I was about 13 years old. So I think I played the game for almost about 15 years. Of course, I played professionally at a very high level when I started finishing playing. I think in water polo, in team sports, is very important because in team sports, you need everyone. It's not a one-man game. And that's extremely crucial. But more importantly, I think sports, with anything in life, it goes back into life and in investing, right? When I was playing water polo, we were training almost 11 times a week. Twice during the weekdays, once on Saturdays. And that's kind of how crazy it was, right? Yeah. In the mornings, we would start our mornings and we have 7 a.m. sessions, train for an hour and a half. In the evening, we'll have evening sessions that range from 6:30 to all the way to about 9:30. This was day in, day out when I was playing with the Singapore national team back then. It was a true test because you needed to have a particular sense of grit and determination to really get through it, to be sticking in day in and day out. Because a lot of times in sports, you can be working on something, but you don't see that minute improvement.
Yeah.
It's really about constantly working on something that really causes you to have that very big improvement. Like, to give you an example, right? I was a very hardworking sportsman. I used to be, I was there always putting in hours. I worked harder, I swim harder, I shot faster, I train harder. I put in that. But sometimes in sports, it's not about just working harder. You got to be working smart. And so what happens is that I was actually one of the oldest during my batch to actually play for Singapore in the national team to represent and to play in the SEA Games. in my very last year, I had to make a call. I was actually the last to make the team. I had to make a call. It's like I wanted to play. It was my last year, but I was not there. So in my last 6 months to 1 year, I was very intentional. I was like, okay, I need to be very intentionally saying, what wasn't I doing right, or I could have been doing better, and always been focusing on that. So when I intentionally actually did that in my very last year, I had a massive improvement in terms of how I was playing the game. And that, to be honest, I didn't why. It took me 10 over years to realize that. I mean, when you could be playing the game and you could be doing very small improvements, right? The coach tells you to do something, that is fine. But when you're doing really very, very intentional of what you are as an individual, that truly dawned upon me that the importance of self-reflection and very intentional and very deliberate learning. And that truly was when I would say, the mastery of the game, for me, to a different level. And I think that goes back into investing and into life, right? A lot of the times when we think what we do is kind of like an exponential curve, but sometimes that's what James Clear says. Sometimes it tends to goes up, but goes down into this valley of in between, and unknowing. And before you see the exponential, and really, I think a lot of it sometimes is in life, and I think most importantly, it's really in the ups and downs when you're really trying to see it. And I think that's also the same thing, right? The stock market goes up and down, right?
Yeah.
It doesn't mean that you are a bad investor. It doesn't mean that you're a good investor. It just means, people are just reacting to it, right? I think it helps to have that mindset and the temperament that I have in investing, which I think is so important.
Yeah, that's a great answer. I love it. So I'd love to hear, just talk me through. So you've got your book, Vision Investing. Just talk me through your thoughts. Why do a book? Your process of doing it, and yeah.
So I think when I quit my job with JP Morgan, that was when I had a 1 month break, and I decided it's time to do it now or never. So I have always been writing all my the content for the book, so I kind of had the content probably maybe about 50-60% of the content being done, but it's always being written when I had time. So I decided, why not write a book? Why not compile all that I have in my content in it and really be able to share with the world, right? Because for me, I think I've discovered the path to what I think could potentially work, and I wanted to show in a very logical approach. Because for me, when I was trying to learn investing, I was trying to read a lot of investing books. And there's no one investing book that was trying to teach me investing in a particular way. So I was learning very small blocks, but not in a very entire block that I felt could be important to me as an individual. Mathematically explaining to me why I need to invest, why I need to invest long term, why should I be investing in this particular way, and very also scientifically proven, with numbers, and to show that, right? So to me, it's always a game, right? Find out and then have that as a template and share that with the world. Because to me, ultimately, I think when writing the book, it's really about the collective. There's only so much I can do as an individual. If the world invests better, invest in greater companies, I always think about it from a flywheel, we get more people to invest better. If people are investing in greater companies, the companies could do well, right? And a lot of other companies will also tend to come in that. And it goes back in that flywheel of which the world goes into a better outcome and a better state, right? And I think fundamentally that is, so it's not really like ESG, but it's really a more philosophical, higher end state of ESG, not ESG just for the sake of ESG, right?
Yeah.
But it's really a very philosophical way of how we're thinking about this, about really making your portfolio reflect your best vision for our future, right? And that's very intentional. When I'm really writing the book, just to share that, right, of the whole entire process and be very transparent. And I think, just to do it. I think that was really just the thing. And of course, writing it during COVID was the most challenging. I wrote it actually in about 3 weeks, every day in, day out. As you can imagine, I was actually writing it for about 14-hour days, every day consecutively for 3 weeks. I think it goes back to how I do sports, right? If you can do that, it's almost always the same. So I was really just grinding it and just writing it.
Yeah.
And of course, the whole process after that took me another 6 months before I got it out to print, because the whole process of proofing and stuff. But I think it really is just sharing the world.
Yeah.
I believe if I could help positively impact a few other people who could invest better, that's good enough for me. Of course, if I can help more and that changes the world, I think that truly is a way of doing. Because I think you can only do so much on your own as an individual. The collective is just much better.
Yeah. Oh, that's great. And totally remind me of a sportsman. It's all or nothing, isn't it? Like, you got to go. But yeah, if I could sort of go into my sort of final three closing questions. For sort of younger generation today, what do you think are some of the most undervalued life experiences that students don't give weight to? Like, what is an underrated skill or experience that you think university age students should have?
I think in any university education, it's really always about asking why and digging in, not just taking something that is being taught to you at face value. Ask, why is this being taught? Why is this the case? Why should I be doing it? Right? I think it's very important for us as, for anyone, university students, for example, just to really try to understand that. I think most importantly, managing our own financial life is not being taught. I would highly recommend that, that we should always, manage our financial life. And it's a book that, for example, that I read that really fundamentally changed my life, which is by T.R. Ecker, The Secrets of a Millionaire Mind. Secrets of a Millionaire Mind. And I think that really fundamentally changed the way I look at money. Managing money is one of our most important things in life and is not being taught in school. If we know and can have a correct mindset of money, that could fundamentally change. So I give you an example, right? When I was very young, money to me was seen as evil. Money is because I had all the rich people, and the rich people were doing not so good things. But fundamentally, after reading the book and been especially in the last 10 years or so, the way I think about money has fundamentally changed. Now, what if I told you money represents the value of a particular goods and service or that someone is providing to you, and how much sweat and effort they have provided to you, and then you are paying for it. And if I think about it fundamentally, that becomes very different, because money is actually a representation of one's value that one is providing. And when you think about it from that way, if companies are making profits because they're fundamentally doing good, if a company is making a lot of profit just for a very short term, they're not going to last very long, because eventually they're going to take it away. So it always goes back into life. I think about and us. It's about managing money, managing our own, and really asking why. When you're doing your own research, do your own research. Don't take what the financial media tells you. Do your own research. Ask why. Always be constantly asking why, and really try to understand and get down to the bottom line. There's always everything is boiled down to fundamental truths, right? To go and to tie it all back, right? The path to financial freedom is really to make more money, to spend less, to save more, to invest more, to invest well, and to repeat. Those are the fundamental truths to achieving financial freedom. There is really nothing more fundamental than that, literally, right? So it's about really going into that. And I really hope, I think we're moving in the right direction.
Yeah.
Definitely, we're moving in the right direction. So I think I love where the world is going, and I think we're moving in the right direction.
That's the thing. Sometimes, yeah, it just, like all things in life, I guess, it takes time. It takes time for returns, takes time to build up your personal wealth. But yeah, we're getting there. In terms of opportunities, where do you think some of the biggest opportunities lie today for youth? If you were 18 today, like, what would you do, or where would you be going to spend your time?
I think the world is such a beautiful place right now versus where it was for me 10, 15, 20 years ago. We never had the internet. We never had a mobile phone. The world is literally at our fingertips. I think you're able to, one, access to more people, or reach out to more people to really impact their lives. So for example, like I'm on Twitter, you can reach out to some of the greatest investors in the world who are really doing well, and you can reach them out directly, right? Because I would say access actually has been democratized in the way you can actually reach out far better than anyone before, right? And also, I would encourage anyone to go out there and see the world. Try, because when you try, you understand. Try and not go through just the day in, day out, but try and always be constantly asking, why this? No, why that, right? And saying there has to be a purpose of why you're doing something. And when you're doing that, just go out and try and really look at different cultures, experience different things, learn different things, read as much as you can. I hope for more of us to be reading as much as we can, because there's so much knowledge in books. There's so much knowledge in what people are sharing. And the good thing is, again, because of the access, we're actually democratizing the access to knowledge, right? Previously, 30 years ago, you have an expert who has something, a certain opinion, you probably have to go to a conference, right, to find something. And right now, like what Kalani, what you're doing right now in podcast, it's great because you're actually democratizing the access. You're getting the public, the people, to access to anyone, to some of the guys who you think who have valuable opinions to share. And that's part of how we learn, right? And I would say it's the flywheel, it's a cycle. And I think sometimes, as we say, it's karma and serendipity. It comes back in tremendous ways that you cannot fathom.
Yeah.
The world just comes back in crazy ways. So the more you do, the more you learn, the more you give back, the more you share, the more you engage. I think I'll really go for it.
Yeah, for sure. And that's sort of when the best things happen, isn't it? Like you put things out or you learn things with no expectations and things just sort of knock at your door, don't they? In terms of for yourself, what plans or vision, pun intended, I guess, do you see for the next 5 or 10 years? What areas are you most curious about going forward?
So for me, I'm actually currently, so Vision Capital is where I have all my publicly listed companies in that portfolio. So what happens is I just started Vision Capital Ventures. It's actually for privately owned companies, so startups. I started doing angel investing and early stage investing just slightly under a year ago. I've invested in about over 30 startups. That's a very interesting space because right now, when I think about my investing in public companies, I'm really investing in, I would say, the very forward-looking companies. They're really at the edge of time, right? So in the next 5-10 years, right? But when you're looking at startups and some of these very technologically driven startups, you're looking at something that's in the next 10, 15, 20 years.
Yeah.
There's going to be the next Facebook, the next Amazon, the next Google's, right? And it's really about where the world is going. And it's really exciting because that helps to form and shape my perspective of things about how the world is going. And it's eventually very important. So the way to tie it all back, the way how I think about it is I have Vision Capital, which that runs all my public listed investments. I ultimately have Vision Capital Ventures. Eventually, when they get publicly listed, it gets feedback into the main fund. For me, it's also about educating, about trying to reach out and to teach more people. So it's about being an educator at some point in time, not in the immediate future, but I think that's something that I always want to give back. And I think most importantly is philanthropy, really giving back.
Yeah.
I think to me, the best way is not doing charity and just giving money. I think the best way is about usually the way I'll do it philanthropy is really through education. So I'll do it two ways. One way is providing education through universities or giving them scholarships. That's one way. The other way is just really helping entrepreneurs, doing some sort of accelerators or incubators in a way to fund them. Because it's really about ties back to my life mission, right? Helping people to create businesses that create long-term sustainable positive value to run them, to shape and change the world. And that's really, very important because this whole way I'm thinking about it just really ties back down to it. And this is very exciting because I think the world is moving in a very interesting, very, very interesting, and very, very positive direction. I hope we as investors can vote with our money and show the world that we can change the world for the better. And I think that's how it is.
Yeah. Some great points. And yeah, I loved hearing your thoughts. Eugene, thank you so much. It's been a pleasure.
It's been a pleasure, Kalani.
Oh. If you enjoyed this podcast episode, be sure to check the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. Also, be sure to sign up to my weekly newsletter, curated by Kalani, where I share what I've been reading, learning, and watching for that week. Same as the podcast, it's compressed to impress, and I aim for maximal return on the time invested. So sign up at kalanis.substack.com. So that's KALANIS.substack.com. You can also connect with me on Twitter @ScarrettKalani. Once again, links to all content mentioned will be in the description. But until next time, have a good one.